All right, revaluation surplus. Okay. Revaluation surpluses, gains. So those are the gains, right? Surpluses are gains. Those are recognized when intangible and fixed assets, these are going to be revalued in OCI and are not reclassified to net income in subsequent periods, but they may be transferred directly to retained earnings when the related asset is used or de-recognized. So the revaluation surplus, remember, this is an equity account in which is stored any upward changes in value of capital assets. Revaluation, right? We're revaluing our fixed assets, we're revaluing our equipment, machinery, our factories. If a revalued asset is subsequently dispositioned out of a business, any remaining revaluation surplus is credited to the retained earnings account of the entity. Let's talk about this a little bit more. Although, I mean, it's not too critical, but I want you to understand this because it's just good financial, solid foundation for everything you'll see. Let's say we revalue our let's say our factory. Okay, so we revalue it, and now it's worth $20,000 more. So we are going to debit factory for $20,000. We are going to then credit revaluation surplus, which is a gain, right? So we credit it. We know we credit our gains, we debit our losses. Let me move this nice little picture out of the way. I like that picture, but I'll have to move it for now. Then what happens? Well, when the revalued asset is gotten rid of, it's disposed, it's sold, or just thrown out, we are going to get rid of our revaluation surplus for 20, and then we're going to credit retained earnings. Now let's think about this. Both retained earnings and revaluation surplus are equity accounts. So here you're increasing an asset and you're increasing an equity. Here you're increasing an equity and you're decreasing in equity and you're increasing in equity. So balancing out the accounting equation, this is what happens. Now let's say this is only revaluation surplus in IFRS, so super specific. You don't really need to worry about this. This is for you. This is to explain it, understand our whole financial system a little bit better. Let's say it's a loss here. Well, then we're going to have revaluation loss for 20. And we're going to write down our factory. Same thing here. Then we're going to reduce retained earnings once the factory's gotten rid of. And then revaluation loss for 20. Awesome. That is a little bit on what we saw there. Not too important, but I would say just understand this, right? Understanding journal entries, understanding what accounts belong in the assets, liabilities, and equity, super important, and just good foundational understanding for everything you'll see. This will help when you see your equity section and everything to follow through after that.